Hi, this reading is intended solely for people who are blind or print disabled. My name's Eric, and this is this week's reading of Barrons magazine, dated Monday, October 14th of 2024. We'll start with the cover story from Healthcare. Confidential files detail PBM's backroom negotiations and their role in the opioid crisis. PBMs are under the microscope for allegedly inflating drug prices. New Barrons reporting raises broader questions about the industry and its role in the opioid crisis, by Catherine Dunn. In the decades since the U.S. opioid crisis began, more than 290,000 Americans have died from prescription-related overdoses. Purdue Pharma, the maker of OxyContin, has agreed to billions of dollars in legal penalties and pleaded guilty to criminal charges. Pharmacies and drug distributors have signed their own global settlements. Largely overlooked is a group of companies known as pharmacy benefit managers, the gatekeepers that help decide which drugs get covered by health plans across the country. A Barron's investigation showed how these PBMs enabled sales of opioids at a peak of the epidemic. During a 12-month period that ended in late 2017, the three largest PBMs, today units of CVS Health, United Health Group, and Cigna Group, received about $400 million in rebates and fees from Purdue. Those transactions have been treated like state secrets. Barrons is reporting on the details, some from documents marked confidential and proprietary for the first time. The records shed new light on PBM's role in the opioid crisis while offering insight into how PBMs negotiate with drug makers behind closed doors, decisions that impact Americans' access to prescription drugs. PBM's days of obscurity might be ending. The Federal Trade Commission recently accused the industry's largest players of inflating insulin prices. The PBMs say they've worked to make insulin more affordable and have vowed to defend themselves against the FTC lawsuit. Barron's reporting raises fresh questions about the company's involvement in the pharmaceutical supply chain. PBMs receive billions in fees and rebates from pharmaceutical companies, seeking to guarantee that their products get in front of insured consumers. Through their management of so-called formularies, PBMs have the power to grant drugs preferred spots versus competing products, place restrictions on drugs like requiring prior authorization, or to exclude certain products altogether. The industry is dominated by CVS Caremark, United Health's Optum Rx, and Cigna's Express Scripts. Together, they control nearly 80% of the market for prescription claims. The industry records that were viewed by Barrons stem from years of opioid litigation across the country. They're now held in the Opioid Industry Documents Archive that's maintained by the University of California, San Francisco, and Johns Hopkins University. The documents show how financial terms negotiated by PBMs are intertwined with the availability of medicines to consumers. In this case, a powerful painkiller with a legitimate medical use that's also at the center of a U.S. public health crisis. In statements to Barrons, CVS Caremark and Express Scripts each said they're leaders in fighting opioid abuse. Optum Rx and Purdue didn't respond to requests for comment for this article. PBM's power revolves around rebates they receive from drug makers when a patient purchases a brand-name drug. They can also collect service fees, though the disclosure is limited. In the case of OxyContin, the fees ranged from 4 to 5% each time a prescription was filled, according to contracts and internal company documents that were viewed by Barrons. In total, OxyContin prescriptions sent $85 million to Express Scripts, $146 million to Optum Rx, and $173 million to CVS Caremark, according to 1 year of sales data between 2016 and 2017. One set of contracts between Purdue and CVS Caremark indicates that rebates increased if health plans covered higher amounts of OxyContin. When it comes to PBMs, consumers aren't usually direct beneficiaries of rebate payments. After a prescription's filled, rebate money flows from the drug maker to the PBM. PBMs say rebates help lower costs for their clients, including employers offering health insurance plans to their workers. Express Scripts says it passes on more than 95% of rebates to those clients, and CVS Caremark cites a figure of 99%. In recent congressional testimony, OptumRx said it passes through 98% of the discounts. CVS told Barrons that the rebates the company negotiates, quote, are one of the ways we work to deliver the lowest net cost on prescriptions to our PBM clients. Express Scripts says rebates are one negotiation tool that pharmacy benefit managers use to secure the lowest possible net cost on brand name medications for our clients and patients. Those claims ring hollow, according to the FTC. Its insulin lawsuit alleges that PBMs engaged in unfair competition by giving preference to drugs that generate higher rebates and fees. Ultimately, the Commission says the practice became a key factor in the upward spiral of drug costs. In the fall of 2017, consultants from McKinsey started a crisis management project for opioid maker Purdue Pharma. The goal was to make sure that OxyContin remained covered by health insurance plans as negative headlines about the painkiller proliferated and lawsuits began to multiply. Early in the project, the consultants sought input from Purdue account executives who dealt with insurers and PBMs. In your experience with account negotiations, a team survey asked, what arguments about OxyContin have you found to be particularly effective in persuading accounts to keep OxyContin on the formulary? OxyContin's clinical ability to manage pain, ostensibly the reason it be prescribed, came in third place. Coming in higher at number 1 was a reference to that important financial term, rebates that are provided, quote unquote. By the time the survey went out, then President Donald Trump had recently declared the opioid epidemic a public health emergency. In the years that followed, Purdue pleaded guilty to fraud and kickback conspiracy charges related to the marketing and sales of OxyContin. McKinsey, pharmacy chains, and distributors reached settlements around their alleged roles in the opioid crisis. None of them admitted fault. A McKinsey spokesperson told Barrons that McKinsey developed rebates that, in addition to helping maintain formulary status, would help align Purdue's incentives with insurers and pharmacy benefit managers to address the opioid crisis. The role of pharmacy benefit managers, the PBMs, remains an ongoing legal question. OptumRx and Express Scripts are fighting lawsuits by local governments, which accuse them of failing to put safeguards on opioid prescriptions and profiting from sales. Both PBMs denied wrongdoing in new legal filings this past week. A CVS Health spokesperson says the company's $5 billion global settlement finalized last year covers opioid-related claims against CVS Caremark. The company didn't admit wrongdoing. Separately, the Drug Enforcement Administration and Department of Justice have sought CVS's PBM rebate agreements with opioid manufacturers as part of a long-running investigation into potential violations of the Controlled Substances Act, Barrons has learned. In 2021, the Justice Department took CVS to court to enforce a DEA subpoena, including requests for rebate agreements, which government lawyers argued were relevant to the amount in profit CVS earns from potential violations of the law. A federal judge ultimately ordered CVS to produce the agreements in November of 2021, court records show, denying company objections. The court skirmish stemmed from a probe that CVS first disclosed in early 2020. The company's most recent quarterly filing said it was continuing to provide documents in response to the matter. The disclosures don't mention the PBM-related requests. As the government asks for information, we're cooperating and providing it, a CVS spokesperson says. A DEA spokesperson said the agency, quote, does not confirm or comment on active investigations, and the Justice Department didn't respond to requests for comment. The three major PBMs announced new initiatives in the months before the public health emergency was declared in 2017, including restrictions on daily dosage amounts and limits for patients taking opioids for the first time. Several academic researchers told Barrons that PBMs could have done more sooner. The drug middlemen have a variety of tools at their disposal to help insurance plans manage prescription use and cost, such as requiring prior authorization before a patient can fill a prescription, or putting quantity limits on the amount of a medication that a customer can purchase through their insurance plan. I think the writing was on the wall for a very long time before PBMs acted, says Caleb Alexander, a professor of epidemiology and medicine at the Johns Hopkins Bloomberg School of Public Health, who has served as an expert witness for plaintiffs in opioid litigation. This epidemic was in plain sight, quote unquote. As the epidemic gained public attention through 2017, rebates for OxyContin became an increasingly hot topic, memos from Purdue show. Bullet point. During a January 2017 discussion between Purdue and Caremark, a Caremark executive described receiving lots of pressure, quote unquote, from the company's clinical team, given the current landscape pressures and the opioid epidemic, quote unquote. The Caremark executive told Purdue that considerable rebate enhancements would be necessary for his company to maintain OxyContin in prescription plans for Medicare customers. Purdue increased the rebate in the following year, records suggest. Bullet point. After OxyContin was excluded from Express Scripts formulary in 2016, Purdue, quote, met Express Scripts demand, end quote, for a 40% rebate in order to be added back to coverage in 2017, according to a memo. Looking ahead to 2018, that memo said, Express Scripts was asking for a 45% rebate. Purdue's desired outcome for the negotiation was to maintain, quote, preferred unrestricted status and to prevent placement on the PBM's national exclusion list. Bullet point. In June of 2017, as OptumRx planned to add restrictions to the opioid class, a Purdue staffer recommended keeping rebates for Optum at the current level. Our formulary position could be at risk if we don't keep them whole in terms of rebates, a memo on the negotiation said. CVS said it couldn't comment on statements or presentations that were made by other parties. An Express Scripts spokesperson said the Purdue documents, many of which are excerpts that lack context, provides an incomplete and misleading view that's not an accurate reflection of Express Scripts' work over multiple decades to help combat the opioid crisis, end quote. Express Scripts is a leader in the fight against prescription opioid abuse and misuse, and any assertion otherwise is false, he continued. Among the materials in the archive, Barrons found contracts for rebates that rarely surface publicly. The documents are marked confidential and proprietary trade secrets of Caremark. Rebates were defined as a percentage of OxyContin's list price. According to agreements with Purdue that were in place from 2014 to 2017, CVS Caremark received the maximum rebate range of 10% to 19.75% on OxyContin prescriptions if a health plan authorized 4 or more pills a day. The rebate range was cut in half to 5% to 8.25% if that authorization was limited to just 2 pills. Asked to comment on why higher quantities of OxyContin came with higher rebates, a CVS spokesperson said, quote, the rebate language in the contract between Caremark and Purdue did not encourage more utilization of OxyContin. In fact, it did just the opposite. He added, our agreement allowed clients to choose to limit OxyContin without losing out on receiving rebates. The higher rebates for higher dosages was an inherent conflict, says Antonio Ciaccia, president of the drug supply chain consultancy 3-Axis Advisors, who reviewed the contract terms at Barrons' request. "We will pay you more for more opioids," he says of the rebate structure. Doesn't get much clearer than that. In 2017, CVS Caremark restructured its agreement so that 2 pills, rather than 4, satisfied the higher rebate range. Another set of contracts pertained to Medicare prescription plans served by Caremark, known as Medicare Part D. The agreements, beginning in 2013, gave special treatment to 80 milligram OxyContin tablets, the highest dosage in the contract. The terms stated that Purdue would only pay rebates on the drug if plans permitted prescriptions of at least 4 pills a day. Those terms were modified in 2017 to remove the 4-pill requirement for 80 milligram rebates. These agreements between Caremark and Purdue wouldn't have been reviewed by a key regulator, the Centers for Medicare and Medicaid Services, which oversees the Part D program. Per the statute, CMS is prohibited from interfering with Part D plan and drug manufacturer rebate negotiations, the agency told Barrons, and as a result, we do not review agreements between the Part D plans or their PBMs and manufacturers. In September of 2017, CVS committed to leveraging the capabilities of CVS Caremark in the fight against opioid abuse. Caremark would limit daily dosages based on strength, the company said in a press release, and limit the supply for some patients new to opioids. Quote, "I want to acknowledge CVS Caremark for announcing last month that it will limit certain first-time opioid prescriptions to 7-day supplies, among other important reforms," then President Donald Trump said at the White House event in 2017, where he declared a public health emergency. "And I encourage other companies to do their part to help to stop this epidemic." 2 weeks later, a McKinsey consultant spoke with 2 Purdue account directors about growing risk to OxyContin insurance coverage and the bulwark that rebates had provided for years. That evening, the consultant sent an email to a colleague summarizing the meeting. Bottom line, Purdue generated a lot of rebates and lots of patients are on it, which protected Purdue. From the cryptocurrencies section of this week's Barrons magazine, Bitcoin's jump is boosting MicroStrategy and other crypto stocks. Be Careful, by Paul R. LaMonica. Bitcoin is surging yet once again, and so are crypto-linked companies. But be careful. Those stocks, software provider MicroStrategy, and trading platforms are even more volatile than the digital coin itself. The November election is driving Bitcoin, now roughly $66,000, up 10% in just the past month and up more than 45% this year. Traders are betting on an upside for the world's most valuable crypto, regardless of whether Donald Trump or Vice President Kamala Harris wins. Trump has morphed from Bitcoin enemy to ally, and Harris is promising to encourage innovative technologies like digital assets. MicroStrategy has done even better than Bitcoin, up 50% in the past month and 230% this year. The company owns 252,220 Bitcoins worth $16.5 billion, more than a third of the company's total market value. Brokerage firm Coinbase and Robinhood, too, have popped. Both have big crypto trading arms. Then there are Bitcoin mining stocks, Mara Holdings, and Riot Platforms. Higher Bitcoin prices should bump up investor demand, buying and selling. Consequently, miners look to generate new blocks. And who doesn't like big gains? Nobody, right? But that doesn't make those pesky risks go away. Bitcoin is ridiculously volatile, despite thinking it's the new gold or an eventual replacement for the US dollar. The price is still more than 10% below March's record high of just under $74,000. Most of the crypto stocks have suffered from even bigger swings. Coinbase is nearly 35% below its 52-week high. Mara and Riot are off about 30 and 45% this year, respectively. Yes, these stocks are all prone to catch a bid every now and then when Bitcoin goes up. But with the exception of MicroStrategy, which is arguably the most skin in the crypto game because of its huge direct ownership of Bitcoin, most of the stocks in the digital ecosystem don't hold their gains for long. Valuations have to come into the picture too. The crypto stocks all rank right up there. Coinbase trades at nearly 40 times 2025 earnings estimates, about twice the multiple for the broader market. Riot Platforms and Mara are both expected to lose money in 2025. They trade for 4 and 5 times 2025 estimated sales for next year, a premium to the S&P 500, which trades for less than 3 times expected revenue. And then there's MicroStrategy, which isn't expected to earn a profit this year, next year, or in 2026. It trades at a stratospheric price-to-sales ratio of almost 95 times 2025 revenue forecasts. Even the most devout of crypto evangelists should concede that this is more than a bit frothy. Sure, MicroStrategy and the others might keep rising as long as Bitcoin keeps climbing. But Wall Street isn't betting on the party lasting forever. The consensus price target on MicroStrategy is $209.50, which is about the current share price. Next, we have a feature on oil. Oil's war premium is back. Can prices top $100? As violence escalates in the Middle East, traders are scooping up oil-sensitive stocks and options. It's a risky strategy, by Avi Saltzman. In the span of 2 weeks, oil investors went from being as pessimistic as they've been in more than a decade to placing a surge of bullish bets on $100 prices. As Israel's war with Iran escalates, oil's war premium is back and could stick around for months. A war premium doesn't mean prices will go up in a straight line. Investors should be prepared for large swings, both up and down. Hours after climbing above $80 per barrel for the first time in months last week, international oil prices fell 4% on news stories suggesting that Israel wouldn't attack Iran's energy infrastructure. They're now trading around $79. Experts are seeing 3 possible scenarios depending on the extent of the violence ahead. Absent a quick resolution to the Israel-Iran war, oil prices will likely stay above $70 for weeks, several analysts predict. In the event of a wider war, prices could rise to $90 or even above $100. Traders bought a record number of bullish call options on oil after Iran's latest attacks, with many of them paying off only if prices hit triple digits. The global turmoil doesn't change the fundamental case for giant energy stocks such as ExxonMobil, but it does introduce a speculative element that could lift the stocks when their earnings are otherwise on the downswing. Some energy investments that are especially sensitive to oil prices could also get a lift. For the past 2 years, the wars in Ukraine and Israel have had very little effect on the oil market, even though they involve countries, Iran and Russia, that collectively produce more than 10% of the world's oil supplies. Russia has been able to export about as much crude as it did before the Ukraine war by routing more of its supplies to Asia. Iran has actually increased its production even as it's become more directly involved in Israel's war with Hamas and Hezbollah. Oil spiked immediately after Russia's invasion of Ukraine in 2022, but slumped within a few months. Investors who have bought oil to profit from global conflicts have mostly lost money over the past 2 years, so they stopped doing it. Oil is still down about 10% from when Hamas attacked Israel a year ago. Instead, investors began ignoring the wars and focused on a broader risk of oversupply in the oil market, with Chinese demand slowing and OPEC expected to start exporting more oil starting in December. Sentiment turned very bearish in mid-September, forcing prices below $70. More traders placed bets that oil would fall than that it would rise. The first time that's happened since those statistics started being kept in 2011. Until now, most analysts supported the strategy of ignoring geopolitical headlines, but that's changing. This time it feels different, writes Natasha Kaneva, the head of global commodity strategy at JP Morgan. In general, the oil market's well balanced today, with production keeping up with demand. But oil companies may have grown complacent. They're keeping less oil in storage than their historical average, Kaneva notes. That leaves less room for error if the war in the Middle East knocks some of the Iran oil production offline. The current situation suggests that until the conflict is resolved, the odds favor a sustained geopolitical premium in crude price, she writes. How high oil could go depends on the path of Israel's conflict with Iran. Since October 7th of 2023, Iran had mostly fought through its proxies, supporting Hamas, Hezbollah, and the Houthi militant group in Yemen in their attacks on Israel. In April, Iran and Israel lobbed missiles at each other in attacks that seemed choreographed to avoid near-term escalation. But in the past month, those guardrails appear to have come off, with Israel killing Hezbollah leader Hassan Nasrallah and invading Lebanon, and Iran launching more than 200 missiles at Israel. It will be harder to contain this exchange than after April's failed Iranian attack, writes Evercore policy analyst Krishna Guha. Israel's government sees this as a potential 1967-1973 moment when it can remake the regional security order on its terms and secure a new balance of power in the region. The most likely scenario, several analysts say, is that Israel will respond to Iran's latest missile attacks by targeting its military sites and perhaps destroying some low-level energy infrastructure. Eurasia Group, which does geopolitical risk assessment, anticipates that those kind of attacks would cause Brent crude prices to trade in a range of $80 to $85. Iran is one of the top 10 oil producers in the world, pumping out 3.4 million barrels a day and exporting about half of that. Israel is considering targeting Iranian energy supplies, according to recent comments by President Biden, who says he's opposed to that course of action. If Israel attacks Iran's oil fields or energy export facilities, prices could rise above $85 and potentially as high as $100, according to Eurasia Group analyst Henning Gloysten. What happens next will depend on the response by Iran and other governments in the region. Even at the low end of an Israeli strike, we could see tit-for-tat actions taken on momentum, wrote Guha. Broader escalation would lead to the third potential scenario, a widening of the conflict that involves other countries and sends oil prices well over $100. Iran could target energy operations in other parts of the region to internationalize the cost, writes RBC Capital Markets analyst Halima Croft. For instance, Iran could try to block oil tanker traffic in the Straits of Hormuz, which connects the Persian Gulf to the Gulf of Oman on the way to major export markets such as China. Up to a third of oil supplies flow through the strait. That would cause a sharp and significant spike well past previous record highs, writes Citi analyst Francesco Martocchia, though he thinks such a spike is unlikely and would be temporary. One way to invest would be to buy energy stocks that have lagged behind their peers and have high leverage to an oil price spike. Some names that fit that bill are BP, SLB, Cenovus Energy, and ConocoPhillips, writes Jefferies analyst Lloyd Byrne in a note. The downside is that those stocks also move on other factors and could also fall if volatile oil prices cause a broader market sell-off. There are more direct but riskier approaches too. A popular strategy that retail traders are taking today is to buy bullish call options on the U.S. Oil Fund, an exchange-traded fund that invests in oil futures. Buying calls involves paying a fee for the right to buy an asset at a set price, and if it exceeds that price, the buyer can turn around and sell the asset at a profit. If it doesn't exceed the price, the buyer only loses the fee. If you're looking for the lottery ticket, I think that trading USO options is the bang for the buck, if that's your thesis, says Rebecca Babin, senior energy trader at CIBC Private Wealth US. She expects oil to rise on any Israeli retaliation, but is more likely to sell the spike than to buy into it, she adds. There's no fundamental reason for average investors to wade into such a volatile trade. This is a binary situation, she says. You either have to embrace it or say, I'm going to live to fight another day and not play this event. From the taxes section of this week's Barrons magazine from Monday, October 14th of 2024. The IRS will use AI to do more tax audits. What you need to know, by Karen Hubie. Artificial intelligence is bad news for tax dodgers. After early successes using AI to identify sophisticated tax evaders, the Internal Revenue Service plans to increase audits to levels not seen in decades for big businesses, wealthy individuals, and people earning more than $400,000. Last month, the agency announced it recovered $1.3 billion in overdue taxes through audits over the past year, focusing on individuals with more than $1 million in annual income. It also collected more than $375 million in check fraud crackdowns, efforts that wouldn't have been feasible without the use of AI. Now, with a whetted appetite for collections, the agency forecasts that by 2026 it'll be auditing 50% of all taxpayers with incomes of more than $10 million and 22.6% of corporations with assets in excess of $250 million. That's up from 11 and 9.8% respectively in 2019. Broadly, taxpayers earning more than $400,000 are in the IRS's sightline for heightened enforcement. These enforcement goals are achievable, assuming the IRS continues to receive the $60 billion in incremental funding over 10 years that was granted under the Inflation Reduction Act, the IRA, of 2022, allowing it to expand its AI capabilities, says Mark Friedlich, a tax attorney and vice president of U.S. Government Affairs at Wolters Kluwer. The resources granted under the IRA and the resulting application of AI machine learning and fraud detection have been pivotal for the agency's tax collecting abilities. 2 decades of budget cuts have atrophied the agency's enforcement arm, causing the nation's tax gap, that's the difference between what's owed and what it collects, to swell to an estimated annual $700 billion. With AI, millions of lines of information can be looked at in minutes or hours instead of weeks or months, says Martin Fiore, America's Deputy Vice Chair of Tax at EY. This raises efficiency and allows humans to focus on more value-added areas, such as making the consumer experience in dealing with the IRS easier, Fiore says. The IRS receives about 4 billion forms each year. Consider the avalanche of more than 1,000 different types of tax forms, such as 1040s, W-2s, 1099s, forms to extend and amend returns, and third-party forms from employers, financial institutions, and government agencies. Cross-checking data to ensure taxpayers accurately report income is sometimes straightforward. A salaried workers' reported income can be checked against the W-2 that's filed by their employer. AI can help when it's impossible for the IRS to do a simple cross-check. For example, gig workers' income is reported on Form 1099, but it most likely won't match the taxable income that's reported on a tax return after the worker factors in deductible expenses. For an Uber driver, there's no independent information the IRS receives on how much gas they used, says Janet Holzblatt, a senior fellow at the Urban Brookings Tax Policy Center. AI helps identify returns that have anomalies, such as bigger than normal deductions for gasoline among gig workers. AI helps identify patterns and trends indicative of tax evasion that would be impossible for IRS agents to identify otherwise, Friedlich says. It also compares data from global sources with taxpayer filings to flag discrepancies. In a recent win for the IRS, AI identified schemes in which labor contractors made IRS Form 1099 payments to non-existent subcontractors and used shell corporations to funnel money back to themselves, Friedlich says. This allowed contractors to claim substantial fraudulent tax deductions. AI also recently identified hundreds of U.S. taxpayers with foreign aggregated account balances exceeding $1 million who failed to file a report of foreign bank and financial accounts, or an FBAR, he says. The use of AI in enforcement could potentially bring more equity to IRS audits, says Rachel Snyderman, Managing Director of Economic Policy at the Bipartisan Policy Center. Simpler returns have been disproportionately audited because they're faster and less expensive to audit than complex returns, she says. In 2022, taxpayers with income of less than $25,000 a year were 5 times more likely to be audited than the average taxpayer, according to the Transactional Records Clearinghouse, which is a data gathering organization at Syracuse University. Increased enforcement for higher income taxpayers is still in its early stages, Friedlich says. For example, in fiscal year 2023, the IRS has increased its audit individuals with incomes over $1 million by 43% over the previous year, he says. That sounds great, but the audit rate for people with $1 million plus was abysmal in 2022 and prior. 43% of virtually zero is not all that significant. Similarly, while the IRS plans to raise the audit level for big partnerships tenfold by 2026, that means to just 1% from 0.1%. Just the same, taxpayers shouldn't be complacent, says Ryan Losey, Executive VP of PIASIC, which has seen a pickup in audit activity among his clients with income between $500,000 and $1 million. For the past decade, I averaged about 1 audit a year, and I have 500 clients, Losey says. 10 months into this year, I've already had 3 audits, and another client just got a notice. Always an important feature. The China section of Barrons for October 14th. How to play emerging markets now. The rally in Chinese stocks gives long-suffering investors in emerging markets reasons to be optimistic, by Reshma Kapadia. For investors in emerging markets, September brought a welcome double dose of good news. Days after the Federal Reserve cut interest rates to keep the U.S. economy humming, Chinese policymakers ratcheted up their efforts to stabilize their struggling economy. Emerging markets tend to do well when the Fed is cutting rates and the dollar's weaker, in part because it lowers interest rate costs for companies and entices U.S. investors to get more for their dollars abroad. The other big boost, China. After a continued deterioration in the economy, Beijing last month took coordinated steps to stabilize the situation. Bigger interest rate cuts, proposals to support the domestic stock market, and vows for more fiscal stimulus. That sent Chinese stocks soaring, making them the best asset class in the past month with a 30% gain. It's been a long wait. Emerging markets have been in the shadows of U.S. stocks for the past decade. The S&P 500 index trounced everything else, returning a cumulative 250% compared with 53% for the MSCI Emerging Markets Index. But in August and September, emerging markets started to outperform, returning 8.4%, beating the S&P 500 by 4 percentage points. That doesn't guarantee smooth sailing. Details on both size and scope of China's stimulus are still a mystery. Volatility is likely to continue in coming months as investors dissect the specifics and analyze its effectiveness. But even fund managers, who are skeptical that Beijing's measures will heal battered household and business confidence, see the new stance from policymakers as a marked change that could help the market in the near term. Good news related to China helps emerging markets, and not only because China makes up the largest weighting in the index at almost 30%. Emerging markets broadly are well positioned for the geopolitical shifts at play. As the U.S.-China rivalry reshapes global trade, Jory Nodeker, head of the Polar Capital Emerging Markets and Asia team, sees a shift toward a multipolar world where capital and growth shift away from China and toward countries like India, Vietnam, Indonesia, and Mexico. Those countries become critical to companies and other nations as they try to diversify away from China or become more self-reliant. As China's economy and market struggled in recent years, India emerged as a star, with the MSCI India Index returning 51%, while the MSCI China Index lost 15% over the past 3 years. The draw for India? Well, an economy growing at 7%, a young population, and a slew of reforms that have made it a more hospitable to foreign investment, as well as improved digital and physical infrastructure and a bolstered manufacturing sector. The trouble is that the India market is expensive at almost 24 times next 12 months' earnings, near a record high. With a red-hot public offering market and money flooding in, long-time investors are turning cautious. We are setting up for a major correction in India in the next year. People are so euphoric, says longtime India investor Ajay Krishnan, lead manager at Wasatch Emerging Markets Select Fund, WAESX, which has beaten 94% of its peers over the past 5 years by averaging a return of 10%. Catalysts for such a pullback range from a weaker showing for Prime Minister Narendra Modi's coalition in state elections in coming months, or more enthusiasm for China that leads investors to reshuffle allocations. But Krishnan welcomes any correction as it would give him the chance to buy in a market that he sees as a winner over the long haul. For now, he favors higher quality stocks with strong fundamentals that the market's been ignoring. Other parts of emerging markets are also drawing interest, though they account for a tiny part of the index. The prospect of a broader war in the Middle East is a risk, but investors are still flocking to the United Arab Emirates and Saudi Arabia. In the UAE, more than a dozen companies are ready to go public, with another handful in Saudi Arabia. There's broad-based growth, with the UAE emerging as a spot for cutting-edge technology and focus on artificial intelligence and smart meters, says Rajiv Jain, Chief Investment Officer and Manager of GQG Partners Emerging Markets Equity Fund, which has averaged a return of 10% a year for the past 5 years, beating 93% of its peers. Countries in Southeast Asia, including Indonesia and Vietnam, are also well positioned for the continued shifting of global supply chains and the push by countries to become more self-reliant. They also stand to benefit from improving economic conditions in neighboring China. Earnings have been strong in Indonesia, and Jain favors banks like PT Bank Mandiri as a broad way to play that nation. Indonesia has emerged as the world's biggest supplier of nickel, and it's moving to encourage increased investment into the country for those who want to tap its resources. The battle between the U.S. and China for critical minerals could benefit Indonesia and Chile with their reserves of copper, higher investment, and exports, according to a recent note from William Jackson, Chief Emerging Markets Economist for Capital Economics. South Korea and Taiwan stand to benefit amid strong demand for semiconductor chips and other advanced manufacturing. Valuations in some of these companies are also becoming more attractive, according to Nauticare. But China is likely to remain in the spotlight. The surge over the past couple of weeks has been swift. Skittish investors had pared back China allocations, worried about the economy's trajectory, policy missteps by Beijing, and the risks related to rising geopolitical tensions with the U.S. The sudden move higher sparked a fear of missing out type rally. One of the cheapest markets, trading at 9 times forward earnings just a few weeks ago, is now trading closer to its long-term average at 11.7 times. HSBC strategists still see up to about 20% gains in China's stock indexes, such as the CSI 300, as Beijing rolls out details of its policies. That didn't come on Tuesday when the National Development and Reform Commission disappointed the market with no specifics, though Jing Liu, HSBC's Greater China chief economist, noted that such specifics would come from the Ministry of Finance and urged clients to have some patience. Even then, some are skeptical the measures will heal the structural issues that the country faces. For Varun Lajawala, co-manager of 91's Emerging Markets Equity Strategy, the scale of China's property bust is a lingering concern. He estimates that more than 90 million units are sitting empty. That's almost a decade's worth of housing inventory. For now, Lajawala and other longer-term investors are looking for pullbacks to add stocks that are likely to benefit from stimulus directed at lower-income consumers, including consumer staples such as beverage firms or appliance makers. Another strategy is to grab companies already seeing stronger earnings trends on their own. Wasatch's Krishnan, who's skeptical about the staying power of the rally, is sticking with companies like Trip.com Group and Meituan as Chinese consumers continue to splurge on experiences, particularly travel. The Vanguard Emerging Market Stock Fund, Index Fund, which is VMAX, V-E-M-A-X, is one of the cheaper broad-based ways to tap the asset class, charging an expense rate of 0.14%. The fund's top holdings include stocks that active managers are leaning toward, irrespective of China's economic prospects. Among them, Taiwan Semiconductor Manufacturing, Tencent Holdings, and Meituan. As of the end of August, the fund had a quarter of its allocation in China, another quarter in India, 21% in Taiwan, and almost 8% in the Middle East, in line with the index. Among active funds, Jain's GQG and Krishnan's Wasatch Select both have strong longer-term records. The value-oriented T. Rowe Price Emerging Markets Discovery Fund has less exposure to both China and India than peers, and a heftier helping to Korea, Thailand, and Indonesia. Top holdings include Saudi National Bank and PT Bank Rakyat Indonesia. The fund's 30% return over the past year beats 70% of peers, according to Morningstar. For those wary of China and India, given the run-up in those markets, the Freedom 100 Emerging Markets Exchange Traded Fund, as FRDM, avoids both, as the fund steers clear of countries with autocracy risk, favoring those that rank higher on its freedom score based on personal and economic freedoms. The fund has 17% of its assets in Chile, with holdings like Minor Sociedad Química de Minería de Chile, that's SQM, which is well positioned for increased demand for lithium and nickel, 3% in Indonesia, and big stakes in Taiwan, with 28% of assets, and Korea, with 15%. From the International Traders section, Russia's oil keeps flowing despite sanctions, and that's exactly how the U.S. wants it, by Craig Mello. 2.5 years after Vladimir Putin invaded Ukraine, provoking successive waves of Western economic sanctions, Russia is pumping about as much oil as ever. And that's the way Washington and other Western governments want it. Russian production has dipped 8% from the pre-war month of January 2022 to about 9.8 million barrels a day, but mostly thanks to compliance with OPEC cuts. From the beginning, the West tried to maximize sanctions without affecting Russia's core industry, oil, says Eddie Fishman, a former U.S. sanctions official now at Columbia University's Center on Global Energy Policy. Avoiding an energy shock when inflation was already rocketing to 40-year highs took precedence over a strike at Russia's economic jugular. That's a comforting thought as crude prices head north again on Israel's confrontation with Iran. It's not so comforting for those hopeful that Putin would make peace in Ukraine. Sanctions did aim to cut Moscow's earnings from oil sales, and they have some. The European Union stopped buying Russian oil in the winter of 22 and 23. Exports rerouted elsewhere were supposed to be subject to a $60 a barrel price cap. The EU and UK would enforce that by denying tanker insurance, which they dominate, to non-compliant shippers. Moscow countered by assembling a shadow fleet, quote-unquote, of 300-some second-hand tankers, says Craig Kennedy, an associate at Harvard's Davis Center for Russian and Eurasian Studies. It tacked on mystery insurance that was good enough for India or China, which stepped in as buyers. The Biden administration started sanctioning individual shadow tankers last autumn, then stopped this February as Houthi militias in Yemen continued to threaten Red Sea shipping. Kennedy notes another apparent concession to U.S. pump prices. The expense and bother of shadow fleet shipments to Asia are still costing Russia exporters $5 to $10 a barrel compared with their former European sales, says Ronald Smith, senior oil and gas analyst at BCS Global Markets. Roughnecks in West Siberia have adjusted well to any shortages of sanctioned Western equipment, and the forced exit of service companies like Halliburton and Baker Hughes, says Hunter Cornfriend, an oil market analyst at Rapidan Energy Group. The domestic industry has continued to perform, he says. The worst economic blow to Russia was self-inflicted when Putin cut most gas exports to Europe in hopes of breaking its resolve to support Ukraine. That's costing the Kremlin up to $20 billion a year, Smith figures. That's more than 1% of their GDP. The free world has stymied the Kremlin's ambitions to replace pipeline exports with liquefied natural gas, forcing French oil major Total Energies out of an LNG partnership in the Arctic and withholding ice-breaking tankers that are only built in South Korea. ExxonMobil pulled out of a joint venture to extract oil from Russia's Arctic, leaving longer-term supplies in question as West Siberian fields dwindle. Russia's status as an energy superpower is fundamentally altered on a 5 to 20-year horizon, Fishman says. For now, though, a trade surplus of $86 billion last year enables Putin to absorb his gas losses and meet skyrocketing military expenses. The next U.S. president, particularly if it's Kamala Harris, could have a freer hand to go after Russia's shadow fleet and tighten other secondary sanctions without immediately worrying about losing an election over domestic gasoline prices. But markets aren't betting on it. Either candidate will gradually push the envelope on Russian sanctions, Rapidan's Cornfiend predicts, but not enough to raise prices. In the Guide to Wealth section of Barrons magazine for October 14th of 2024, the Mag 7 is so yesterday. Play these 7 instead. There are some great buys among large-cap tech names that aren't as big as the Magnificent 7. We make a case for 7 that investors should be considering now, by Tiernan Ray. The universe of investable technology companies includes hundreds that are well established, highly profitable, and have great promise, but that often receive scant attention in financial publications. Call it the Valley of the Forgotten sub-trillion-dollar market capitalization stocks. These are names that don't come up that often because the market fixates on the Magnificent Seven: Apple, Microsoft, Nvidia, Google parent Alphabet, Amazon.com, Facebook parent Meta Platforms, and Tesla. There are some great deals in the sub-trillion-dollar group that have relatively modest valuations, as well as outsized potential for revenue and earnings growth. For deep value, your first stop below $1 trillion should be the semiconductor group, both chip makers and the companies that supply the equipment to make the chips. Chip makers are by no means unknown to investors. Given the obsession with artificial intelligence, however, Wall Street is focused on just a couple of names to the exclusion of the rest. One stock towers above all others, of course: Nvidia. If investors look lower down the market cap ladder, they tend to consider the next biggest chip maker, Broadcom, at $805 billion in value. Both are superb companies, but are substantially more expensive than they have been in the recent past. Instead, there are three prominent names currently out of favor that deserve your attention: ASML, Micron Technology, and Lam Research. All three stocks are cheaper now than they were 6 months ago, and their stock prices reflect a host of worries. One is the U.S.'s continuing trade war with China, which is leading to more restrictions on semiconductor and chip equipment exports to the Asian nation. The U.S. is steadily increasing the scope of restrictions, which reduces the opportunity for ASML and others in a huge chip market. But that threat has been going on since the Trump administration, and chip companies have proven adept at dealing with it. Frankly, it's old news. The greater worry is that the semiconductor cycle of growth is nearing an end. The Street thinks that in a couple of quarters, the market will turn south as growth cools in artificial intelligence chips, which is the hottest part of the market. Time and again, however, it's been good to buy good chip stocks when such cyclical worries are at their peak, because not long afterward, the stock market starts to focus on the inevitable upturn. By the time that happens, it may already be too late to buy their shares. Moreover, fixating on the cyclicality of the industry misses important long-term developments that are making all three chip makers very valuable. Micron is entering a sort of golden age for its dynamic random access memory, or DRAM chips, which are used to store the most recently used data in a computer. AI demands more memory to work, which is pressuring DRAM makers to produce faster and more capacious chips. It's also forcing them to reinvent the chips so they connect more intelligently to the main central processing unit, or the CPU, of a computer. That shift means that before too long, Micron will be designing its cutting-edge DRAM, called high bandwidth memory, in close collaboration with Nvidia and other processor makers, making Micron a much bigger player. Lam Research, which specializes in developing the machines that etch silicon and deposit layers of chemicals onto chips, has a particular focus on memory chip making, so the reinvention of DRAM is good for Lam. ASML, which makes laser light sources that are required in the formation of ever smaller circuits, is also tied into that increasing sophistication in memory. Beyond the semiconductor names, the best place to look for overlooked growth stocks is among smaller software companies. IT tools maker Datadog has among the best growth profiles in all of software. While this year's expected revenue growth of 27% could cool to 23% next year, that is still strong in a market where many software firms struggle to grow faster than the teens. Datadog's valuation is best measured by looking at its market cap divided by its expected sales over the next 12 months, a measure also known as the price-to-sales ratio. On that score, it's pricier than many stocks at 12.6 times, but that's 16% less than what the stock traded for 6 months ago. Another excellent software name that's fallen out of favor recently is Snowflake, a data analysis software firm. Its growth is comparable to that of Datadog. And with its stock down 42% this year, its price-to-sales ratio has collapsed from 14 to just 8.6. This is a fire sale price for a company with substantial growth and a very healthy free cash flow margin. And with that, we have come to the end of our reading of the Barrons magazine for October 14th of 2024. This is your reader, Eric, saying be well, be safe, look after each other. Remember our veterans, especially the ones we've lost recently. Bye for now.